you know, they queued up the March rate hike. It's going to happen soon. He said the Feds have a mind to move in March. They've talked about liftoff. He did say the Fed's ready to respond appropriately to inflation that could persist more. Was Jay Powell, is the Fed right now hawkish, dovish, or in the middle?
You know, I think the right answer is it's been dovish and it's moving in the hawkish direction. I mean, if you look at where the policy settings are now, the interest rate is zero practically. They're still buying bonds. That's about to end, but it hasn't ended yet. So it's hard to say that they're hawkish right now, but they certainly are feeling the need, the imminent need, the immediate need to move in that direction, at least somewhat.
So inflation is high. I know you are still in team transitory. What are the odds that that it will be so transitory that Jay Powell will once again, you know, maybe pull that word back into his lexicon and the Fed won't do the 4 rate hikes that everybody's expecting?
I think the odds that they won't do 4 at all are very, very small. Think about where we are now. We're almost at a 0 rate. A 4 rate hike puts you just above 1%. That's hardly a central bank that's trying to clamp down on its economy. But if you know, I want to clarify that team transitory, at least this branch of team transitory, doesn't think inflation is about to tumble off a table. But if it does, the Fed will slow down abruptly whatever it was planning to do on inflation. On interest rates.
Okay. Well, you know, it seems to me one of the reasons that the markets took this badly was that Jay Powell was pretty upbeat on the labor market. And I think people thought, well, maybe that would hold the Fed back from being aggressive. Let's listen to what he said in answer to some questions.
I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market.
Sounds like he is quite comfortable, if not satisfied, with where the labor market is now. He'd like to see more people get back to work, right, and participation go up. But it does, as long as things stay roughly where they are, is this just another reason to expect, yes, the Fed's on a rate hike path. They're going to hike rates until they see inflation starting to crumble, and they don't really have a set plan for if it's 3, 4, 5, or whatever.
I think that's right. They couldn't have a set plan now. But as I said before, stopping before 4 rate hikes, which is just 1 percentage point if they're each 25 basis points, seems very unlikely to me, you know, unless the economy starts cratering, never mind slowing down, but cratering, and that doesn't seem likely either. So they'll be watching inflation. They're not necessarily, you know, some people think they have to go to 3, 4% eventually on the funds rate. You know, I doubt that. It's possible, but I doubt that. But they know that it's a possibility. And it's just going to be data dependent.
Mm-hmm. Alan, one of the things the market was looking for was some idea of when this enormous, almost $8.9 trillion balance sheet is going to get run off, and no real timing given around that. So how much is that going to be a source of uncertainty for markets?
It will be, but, you know, these are very large markets, and the Fed is going to do whatever it decides to do, whatever roll-off schedule it decides is appropriate, pre-announced, very open, everything will be public. Probably, you know, people that are deep in the markets will be almost to tell you down to the QSIP what's going on, what's going to happen in the next few months. The Fed is not going to use that as an instrument to surprise markets, either on the hawkish or on the dovish side.
It's still really moving decisively towards a tightening stance, right? So how difficult of a balancing act will it be for Fed Chair Powell to trying to have this inclusive recovery that they wanted, but at the same time, we know that inflation, of course, really hurts the most vulnerable first?
Well, first of all, I think they've largely achieved the inclusive recovery. You can sort of see you can sort of see that in his words and his body language. He doesn't want to say, you know, Why would he say, I don't want one single more American to get a job, especially if they're a minority? You know, he's not going to come anywhere near saying that. But I think he made it clear that the Fed is pretty satisfied with the labor market. That last point you made, I think I would take issue with. The data over decades show that, and this comes to the stock market, by the way, that it's the rich people that are hurt the most by inflation because they own the stocks and the bonds. And if stocks and bonds go down in value, it's not the poor people that are losing wealth. They didn't have any wealth to begin with. It's the rich people. You know, I often say poor people have a harder time coping with anything. You know, bad weather, mosquitoes,
Okay.
common cold, you name it. It's not good to be
Okay.
poor.
I want to ask you a quick final question, Alan. What would it take, quick final answer as well, for the Fed to do a more aggressive move, 50 basis point rate hike, move that balance sheet runoff to May rather than waiting until June or later in the summer?
I think they'd have to have an inflation surprise. You mentioned I'm on team transitory. So's Jay Powell, and so is the center of gravity of the FOMC, and they would have to conclude that that was wrong. This is going to last a lot longer than they thought.